Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is Brett Heath. Brett is the Chief Executive Officer and Director at Metalla Royalty and Streaming. Brett, welcome to Wall Street Silver.
Thanks, Evan. Thanks for having me.
Yeah, it's a huge pleasure having you come down to Wall Street Silver. This is your first time on Wall Street Silver. So please, I just wanted you to talk about, how you first got into precious metals and how did it all start?
Well, originally I have an economics background, which drove me into looking at hard assets as a way to protect your wealth. And looking into that a little bit further, that kind of led me into the royalty business. I'm sure some of your viewers know about the royalty business, but I think it's one of the best ways to get long-term, non-dilutive, free carried exposure into some of kind of the most premier mining assets that are out there without any exposure to costs. And so in 2016, I founded a company called Metalla Royalty. And in 2018, I co-founded a company called Nova Royalty. And just last year, we merged the two. Now it's Metalla. It's got over 100 different royalties
Wow.
in copper, gold, and silver on some of the most proven geological trends around the world that are, with royalties on projects that are operated by some of the largest mining companies in the world. So it's a really interesting asset allocation approach to the business, and
Right.
it's a really unique way for investors to get good long-term levered exposure to gold, silver, and copper.
Now, a lot of our viewers, of course, they're silver stackers, gold stackers, physical. Some people have the mining producers or even explorers. But royalty, we actually don't talk too much about royalties. I'm sure some viewers out there do know about it. Maybe a lot of them do. But can you break down what is it comparing it to a mining or a producer company? What does a royalty company do in the precious metal space?
Yeah, so we take an asset allocation approach, just like a
Right.
fund manager in the business. But the only difference between owning equities, we own at the asset level called royalties. And what royalties are their interest in the operation. So if you have a royalty on a mine that, let's say, Agnico Eagle is operating, and that mine's doing 200,000 ounces a year,
Right.
and we have 1% royalty on that mine, then that royalty will kick off 1% or 2,000 gold equivalent ounces or gold ounces a year to our account. Now, we don't have to operate the mine. We don't have any kind of costs. We don't have, any type of OpEx or CapEx. So in the event like there's a new mine being built and we've got a royalty on it, let's say the operator's got to raise $500 million to build the mine. Once you buy the royalty, it's completely free carried. So you get that exposure and it's free carried into perpetuity, basically in almost all jurisdictions. I mean, there are a few where it's not, but selectively, if you're in the right spots, like you can have a royalty that gives you basically till the end of time exposure to any type of economic output out of that property at
Pretty
no cost.
awesome. That's pretty
It's,
awesome.
it's incredible, and it allows you to take a really long-term view. And what it does is it allows you to capture a part of the market that I believe is uh, very, let's call it, not well understood, or at the very least, it's a mispriced. And this is the optionality part of the market.
There's about $15 trillion worth of physical gold in the world sitting there costing money rather than being used. It's just absolutely insane. Monetary Metals is bringing gold back into the financial world, putting gold to productive use right now. The problem with gold, of course, in physical form is that it's heavy, it's cumbersome, it's not particularly easy to ship, and it costs money to store in a protected manner. This platform Monetary Metals created is a proven concept and allows gold to be put to productive use. So instead of sitting there costing you money, it's actually in use earning you money.
Learn how you can earn 2 to 5% in our leasing program and how accredited investors can earn up to 12% on silver paid in silver. This advertisement is not investment or financial advice. Minimum investment applies.
And what this means is that when I talk about optionality, it's really when you look at the portfolio as a whole. Like, so for example, like some of our royalties cover 100 square kilometers across
Wow.
some of the most proven geological gold, silver, copper belts on the planet. I mean, you think about that for 1 second, 100 square kilometers. and or even more than that for that matter. And that's just kind of one royalty, two royalties. Like they're very, very big land packages that these things can cover. And over time, if you're in these right places and you've got exposure with a big operator that has a balance sheet to continue to finance exploration on these projects, then they find stuff. They find lots of gold. They spend a lot of money. I mean, oftentimes we'll see hundreds of millions of dollars every year uh, from our operators go
Right.
into properties where we have exposure to, and all of that generates a lot of value. All of that is basically optionality. It's free value. It's new ounces that the royalty holders get exposure to with no cost. So it's a very interesting type of asset, and when you've got a big portfolio of them, then it can be very powerful.
Now, what do you guys look at as a royalty company? What would you look at? Like, you're not just going to give every explorer or every producer money, of course, or like, what do you guys look at?
So we like to come in. I mean, typically the way that we've grown our business and our strategy from day one has been to buy assets that have a very kind of uh, but to buy assets where we know there's economic viability in these properties. So we know
Right,
that there is some type of deposit there. And where we like to come in is where the operator, and typically we focus on, call it the majors and the mid-tiers within the industry. So these are the biggest mining companies. And
right,
we look at their pipeline projects. These major mining companies, they produce sometimes one, two, three. Barrick does 4 million ounces a year. They have to replace these ounces that they're mining.
right.
So they've got pipeline projects, and so we look at these pipeline projects and we buy these royalties where we know there's a very significant deposit there, but the operators don't fully understand kind of what that is, and they're still spending money drilling it, trying to figure it out. And what we noticed is that there's a big value growth curve kind of across that process, and usually kind of in the last 5 years prior to that asset coming into production by the majors or the mid tiers, they spend a lot of money and they
Mm-hmm.
put these projects. So we like to kind of position ourselves generally. I mean, but we also buy stuff that royalties that are in production. We buy royalties that are pure exploration. And really, there's a number of different aspects kind of that we use to evaluate kind of how these royalties should be valued and kind of the optionality and also understanding kind of the timelines and how they fit into the whole portfolio.
No, that's super interesting. And like it's so nice to hear about different aspects of the silver and gold industry. Like you see there you have your physical stackers, you have, there's so many different aspects that we can learn about and keep, of course, learning about. What's concerning you right now, Brett, with the whole market? What's your biggest concern with the economy moving forward, either in the US or in, North America or the world? Yeah, what's your biggest concern?
Well, my biggest concern within the economy right now is that I think that the deficits are getting to a point where they are unsustainable.
Yeah.
And you've got about $17 trillion that has to be rolled over in the next probably 2.5 years. So
Right.
17 trillion of new issue that is on top of whatever deficit that just the U.S. government, not to mention the U.S. government, and I'm speaking about the U.S. government, but also globally, it's a
Right.
similar fiscal situation for much of the Western governments. And so when I look at that, I mean, with lower interest rates, they can keep this game going on quite a bit longer. And we saw the Fed cut, but we
Yeah.
saw the Fed cut and we saw the long end of the curve go up. And so we saw gold go up, we've seen Bitcoin go up, we saw silver go up. And so what does that really mean? Like, how do we interpret that? And how I interpret that is that, I think that these asset classes are moving in advance of probably a second wave of inflation. And the reason is because most of this 17 trillion, as it gets refinanced on top of the deficits that are going to be accruing constantly, most of that paper is rolling off at like 50 basis points to 100 basis points. And now it's going to around 400 basis points.
Right.
So as that happens, the interest expense, which if you look at a chart of the interest expense just for the US government, I mean, you could see it has gone from kind of 250 billion to 300 billion, and all of a sudden it was just like a hockey stick right up to a trillion, over a trillion. And the reason is because the interest expense, and they were able to continue to uh, run these huge deficits because interest rates were going lower and lower, and the interest expense basically like they should have refinanced most of that debt for 30 years at 150 basis points or 200 basis points instead of 50, going on like 2 or 3 year notes. But that's what they did. And so, I think that the market is signaling now for a significant amount of inflation. I don't think that that is going to come
Right.
until probably I think we'll start to see it in the second half of 25, and I think 2026 will really start to pick that up. And potentially, I think we may see the inflation CPI go higher than the previous high, which is, if I recall correctly, right around like 8, 9%.
And that's crazy. If it starts getting back to those levels of, 9%, 8% inflation, and who knows, because I've heard like, there's so many different ways you can calculate inflation. But like that, how does it all end? Because you look back at the Roman Empire, you look at back at every civilization that has fiat currency, and the more they print, of course, it just doesn't end well. Now you're having this debt servicing, you're having $1 trillion on interest, and it's even passing military budget. How does this all end, Brett?
Well, I think, look, it can end in a couple of different ways. But I mean, I think generally, if you look kind of what happened through this first wave of inflation, like if you broadly owned assets and you owned assets, real assets, you didn't, I mean, you did okay during that inflation. A lot of people look around. I had a lot of friends commenting to me just the other night saying, well, I bought my house for 900,000 back in 2018, and now it's worth 2.5 million. I'm like pretty much everything has doubled since 2018. I mean, I think obviously CPI isn't that much, but when you look in kind of real terms, like I mean, when the actual real value, I'm like, most of that is inflation. I mean, most
Right,
of that is all inflation. And so, if you owned those assets, if you owned Bitcoin, if you owned gold, if you owned silver, if you owned good quality companies, then they maintain reasonably, I mean, not all a little bit different, but they
right,
reasonably maintain their purchasing power. And I think that wages haven't kept up.
exactly.
Obviously, cash is has been significantly devalued. I think it's got another significant devaluation over the next few years, and so now is kind of the time when we're kind of in a bit of a trough. Asset prices have kind of calmed down a little bit over the last year or so, and
Right.
I think like now is kind of the time because basically like if you're not covered in real assets, you will probably have most of your wealth basically evaporate over time. And unfortunately, wages just won't keep up.
Yeah, no, it's crazy because I'm here in Canada and you hear it all the time when I go to the gym or anywhere you're going. You just hear people talk about, why is everything so expensive? Why is everything, but they don't understand why. Like they don't
Yeah.
know, why it's because of the debt.
And I mean the truth is that when you look at North America, I mean maybe not counting Mexico, but when you look at U.S. and Canada, I mean the U.S. and Canada has never experienced a very significant amount of inflation.
Right.
I mean, there was a little bit that there was a bit of inflation that kind of came out in the 80s, or sorry, the 70s, which was a long time ago. I mean, the people that actually lived and kind of went through that are um, are still around, but they're very old, and it's been a long time. And so you've kind of got this new generation that has never really experienced what inflation is in
Right.
the U.S., in Canada, in a lot of parts of Europe, over the last kind of 4 decades or so. And so when you go to other countries, obviously, like this happens in Argentina every 10 years, like clockwork. So,
Right.
having kind of a global perspective, you can see that, and you can see kind of the behavior of people and kind of how that plays out. And so this is a much, much bigger scale. Unfortunately, like when when these types of situations happen with kind of reserve currencies, like it's felt globally. Like there's
Yeah.
It's not like Argentina or Venezuela or all these kind of peripheral type of smaller um, countries that have experienced these things. And if you're sitting in the US or Canada, you have no idea what's going on. You see some headlines, you see some news, but if you've ever been in a country that's experiencing hyperinflation, it is scary.
Oh yeah, like I've
Yeah.
only heard stories and never ever lived through it. None of my generation, I'm sure, have seen it, but they're starting to see inflation now.
Yeah.
So,
So I mean, I think that's a concern. I mean, originally, Metalla was, we built Metalla originally as a way to really kind of capture uh, and protect, not only kind of protect wealth, but also capture the upside and the leverage and be able to kind of not only protect but capitalize on this trend and to capitalize on this trend because no one has a crystal ball. Everything always takes much longer than what people expect initially. And so you need to have a long-term view. You need to have a long-term portfolio that lines up with that long-term view. And so that kind of played into our strategy since the beginning. We said, okay, if we went out in 2016, the average mine is in production for about 10 years, and we bought everything in production. Well, guess what? Like we'd be coming up on 2026 and we'd
right.
have no growth. Actually, we'd have a decelerating portfolio. And so understanding that, like we said, look, we need to have a long-term view. We want to build up a big arsenal of the best royalties with the most growth possible. And
Right.
we want that to kind of start to come in line as we get into this commodity cycle. Now, we didn't know when this was going to start. And so, we basically built like a nice ladder of growth and we've got that starting this year, basically this quarter, and we should see continued growth through the end of the decade, which I think lines up very, very well with kind of how this commodity cycle will play out.
Yeah, absolutely. It's such an interesting time in precious metals and it's such a crazy time around the world. But Brett, I wanted to thank you so much for coming down to Wall Street Silver. Where can people connect with you? I'll put the links in the description below, but where can people connect with you?
Yeah, you can go first off, go to our website, which is metalloroyalty.com. I'm also on LinkedIn. You can look me up, Brett Heath, CEO of Metallo Royalty, and happy to have a chat.
Yeah, thank you so much, Brett, for coming down. Everyone for who's watching, please hit the like button and subscribe button. And yeah, Brett, such a huge pleasure. I'd love to have you back on in the future.
Yeah, it would be great.
Awesome. Talk to you soon.